So, hi Rutvik, we will start now.
Yeah.
Thanks for joining in. Hi everyone, we are live streaming on Facebook as well. Just a second. Yeah. And welcome you all from ProfitBoard Ventures and Tax Mantra Global. ProfitBoard Venture is an investment banking and private investment arm of Tax Mantra Global. We recently launched it as a standalone entity. We are headquartered in Singapore, and we help technology enable startups in India and Southeast Asia to raise capital. In fact, I have also started investing in a lot of startups directly. And Investor Talk by Profit Board is an initiative to bring investors closer to the startups and to understand and listen to the stories of investors also. Every investor would have a story very similar to an entrepreneur, because I feel that every investor is also an entrepreneur in that sense. Today we welcome Rutvik. Rutvik Doshi is the Managing Director and General Partner at Inventus Capital Partners. And we will go deep into Rutvik's investment thesis, preference, expectations from startups, and take on the future of investing in the new normal and much more. A little bit about Inventus Capital and Rutvik. So Sir Kanwal Rekhi, he's a mentor to me. He's a mentor to millions of people of Indian diaspora. And John Dougery founded Inventus Capital in 2007 to help founders build category-defining companies. The GPs have backed nearly more than 90 founders to date. Rutvik will correct me if the numbers have changed. Typically at the seed, early stage, and Series A level. And Rutvik himself refers himself as an accidental venture capitalist. We will hear from him why. He comes from product management, software engineering background. He's an IIT Kharagpur alumni, did his MBA from INSEAD, and in his early career, he worked at Broadcom INC and Google also. It's been 12 years when Rutvik is part of the ecosystem, and he has participated in many of the fastest emerging internet ecosystem and companies since 2007. So with this, I welcome Rutvik. Rutvik, thanks again for joining in at such a short notice. And before I jump into some of the queries, I want you to give a brief background about yourself and how the story started, how the journey started for you.
Yeah, Alok, thanks for inviting me and hosting me today for this session. And thanks for the beautiful introduction. It's a pleasure to meet all of you virtually. I wish, that we'll soon get out of this virtual mode and soon be able to meet everybody physically. But till then, this virtual mode is working well. And good morning to all of you. So, Alok, when you were introducing me, you mentioned one term, which is an accidental venture capitalist. And I'm wondering where you picked it up and where you got it, but that is absolutely true. When I now have a 21 year career and been a venture capitalist for almost 10 years. So half my career has been in this world. But to be honest, I never imagined or planned for a venture capital career. Today, if you speak to a lot of youngsters, they say that, hey, I want to be in the private equity industry or VC industry. I never had any such aspirations. In fact, I didn't even know that this industry existed for a long time. So yes, that's why I'm an accidental. At heart, I'm an engineer. Started my career in software engineering, moved on to product management with Google, worked on many early mobile and web related developments which were happening at Google in the later half of the previous decade, which is basically what defined the internet, and that kind of got me very, very interested and intrigued about this ecosystem. So I jumped in and did a startup of my own after Google. But at that time, I didn't have much startup experience. I was an engineer. I was more of a, coming from a technical background. I couldn't make the startup work. It was 2010 timeframe, and it was in the e-commerce space. Didn't realize that e-commerce, building an e-commerce company requires actually billions of dollars. I used to think that, coming from as an engineer, what does it take? So you just put up a website, put up some order management system and you're good to go. But I was actually wrong. It required a lot more capital than what I imagined. So it didn't work out. And that's when I was trying to figure out what to do next. But in the process, I had, dived deep into the startup ecosystem, somehow got to know, everybody who was involved in the Indian ecosystem during those early days of e-commerce, internet, venture capital, etc. And I was trying to figure out what to do next. I came, met Samir and Parag, who are the partners in India at Inventus, multiple times, and they were thinking of expanding the team. And we somehow, I got into the venture capital industry. In fact, the story over there is also a little interesting. When I decided to join, I was still not sure if I wanted to be a VC or not. So, kind of, we agreed upon a dating process, and we said, okay, I don't know what this industry is about. I'm not sure. I'm an engineer at heart. I'm a kind of an entrepreneur. Is this what I want to do or not? I don't know. So let's date for 6 months. I will not join you full time. I will be like an EIR or something. Come to offices, listen to pitches, work with portfolio companies. And after 6 months, if you like me and I like this and we all like this job, then maybe we'll consider. And that's how I started. And 3 months in, I knew that, this is probably where I would like to build the next phase of my career, and that's how I ended up becoming a venture capitalist. So yeah, completely unplanned, accidental in the truest sense. And that's how I got into venture. And it's been 10 years now and I'm thoroughly enjoying it. Yeah.
Wow, 10 years is a long time to be a VC. I mean, you would have seen a lot of cycles. I mean, I call the current wave is the fourth IT wave in India. If I take a couple of minutes, I will tell you why my thesis. So 1968, I think that was the first IT wave when TCS got incorporated and started.
Okay.
And then sometime in 1991, when Infosys and other companies got started, when there was sunset clause with regard to 10 and 10B, wherein there were profit exemptions to IT companies. I think the third wave was in 2006-7 when Snapdeal and Flipkart and those startups came in. So I think the third IT wave was actually the startup IT wave. And right now in the pandemic, when we are sitting, I can see the fourth wave, and the fourth wave is the massive one. And I tell you the two reasons why I feel that we will have more product companies from India, more SaaS companies, product companies, business automation companies, because because of the data penetration for the last 2.5 months, the kind of data penetration, data consumption which is there in our country is huge. And the second is in terms of the technology adoption, which has been accelerated by at least a decade, if not two, because of pandemic, wherein the small and medium-sized businesses are also talking about technology adoption, automation, trying to go digital, trying to understand how they can expand their market, not restricted to a particular geography or a locality where they were operating. I think because of these reasons, I truly believe that we are in the fourth wave of tech startups. And now the startups or products which will come out right from this pandemic will be very good, because they are coming out of challenges and restrictions and resource which is low at this point of time. So that's my thesis. I don't know whether I will be correct or not. I will be known in 5 years if we get many interesting product companies from India now. By 2025, we will be able to know. But your story, Rutvik, is very interesting. And being an entrepreneur who has seen some failure in the initial days after your stint with global companies, and then getting into VCs actually helps you to accept failures. I mean, that's one part which is so critical as an entrepreneur to do. So with this, it's been 10 years now wherein you are a VC. So what has been your investment thesis? What do you see in a founder or in a company when you want to invest? I understand that you typically invest early stage, pre-series A or max at series A. That's what my knowledge is. So what's the thesis? What kind of things you see in a company or a founder?
Correct. So yeah, absolutely right. Alok, we at Inventus, and particularly, the investments that I have done, they're all either pre-series A or series A. There may be one off seed deal, but majority of the investments that we've done are either in the pre-series A and series A stage. Now, let me, and Series A is still very, very early stage. So the biggest bet is still on the founders. The biggest bet is still on the founding team and their ability to execute, their ability to drive innovation, and their ability to attract talent. That is what we look at. So when we are thinking of investments and when we evaluate a company, most of the time there's very limited data because this founder's probably been, running the company for maybe 18 months, at best 2 years. That's the age of the company at which we invest. The founder may, uh, have an early version of the product, some users, some early traction, but not a whole lot of data to really extrapolate and say that, hey, yes, this company is going to make it big, or this company is already out there. So, and hence, when we are looking at it, we look at it from two angles or two perspectives. One is, of course, the market. That becomes the first criteria and the first filter, saying that, is this a large enough market for us to build a large company in a relatively short period of time? So, sometimes you may have a large market, but it may take a long time to build a company. But a large market where you can build a large company in 5 to 6 years time frame, if yes, then it fits the criteria, and then we start diving deeper. And when we start diving deeper, most of the interactions is around the founders and the founders' vision, uh, the founders' ability to attract talent. Most good founders, they have a special insight or a special knack about that market in which they're trying to build that product, and it is that insight which kind of uh, drives a lot of our investment decision. That, okay, here's a founder very, very early in the journey, but probably understands the market and and we believe has the ability to execute and hire talent and grow the company and build it big. And if that checks out, we go ahead and make an investment at that point in time. Of course, we do have some data points and some things because an early version of the product would have been launched. So we know for sure that the founder knows how to build the product, and a product that is being accepted even by an early set of users or a niche set of users. That data point is there and that proof is there. But beyond it, it is largely still on the vision of the founder and belief that this founder will be able to execute and hire talent. And that's what we go after.
Yeah. So large market, if the founder can build it in short span of time, that is 5 to 6 years, correct, clarity in the minds of founders and some traction.
Absolutely. Clarity in the minds of founders is very, very important. And that probably, I would say, has a significant weightage in on the overall decision-making process.
You could tell me something. So since you would be interacting with lot of companies who are at early stage, you yourself said that at early stage you will not get lot of data. Yeah. You don't know whether this model or this business will actually be able to serve or would be validated at a large data point.
Correct.
So how do you? So many times it's actually at the ideation stage or maybe some traction. So how comfortable are you to invest in a startup which is at ideation stage, but the idea is rock solid and there is clarity in the minds of investor? Have you done that just on the ideation stage?
We've done very few. We've done some of them, and at the ideation stage, the reason why we sometimes end up doing is because sometimes the founder walks in and just blows your mind off by the kind of insights that they have on the market in which they're going after. So it is an idea, and they have very, very strong views and strong insights on why their idea will work in this market, what is exactly lacking, where the problem area is, and why this idea will fit in and will rapidly scale. So some of those unique insights they are able to bring in, and they have a much bigger, broader understanding of the overall market and the overall space beyond just their product out there. So that is the stage when sometimes we take a seed bet and say, okay, this looks like, and of course, the other reason where we take a seed bet is also that it is probably an emerging technology. There is, for example, last year or or it's almost 18 months, 20 months back, we did a seed investment in a company which was using blockchains to build supply chain solutions, or implementing blockchain to improve supply chain solutions out there for enterprises. Now that had to be done at an early stage, that had to be done at a seed stage, because we knew that the problem was there. But the kind of insights that the founder had were very, very genuine, were very deep, and it is an emerging technology. And if it's a very emerging technology, you have to take that early leap of faith out there. So if it's an emerging technology like blockchain, we may take that leap of faith, which is early. But if it is a pure, not a deep technology or not an emerging technology, but pure a business model kind of innovation, then our preference is to probably do a pre-series A or a series A, because you want some validation that the market is accepting the product that you're doing. So that's how I would kind of distinguish, within Inventus, how we look at seed versus how we look at pre-series A and series A.
Yeah, so basically more focus on founders, clarity, emerging technology, even if at the ideation stage.
Correct.
So that's good. So Rutvik, my next question would be, in terms of process, how do you evaluate what is the process? Tomorrow, if I want to go and I want to raise capital from your fund, what is a typical process of going and asking you to please evaluate my product or service? What is the process like?
Okay. So there are 3 or 4 ways to reach out to us. One is, of course, you can send us directly an email. My email, for example, is rutvik@inventusindia.com. We look at every email, we look at and try to respond and evaluate everything comes. So if you can directly send an email, if you don't have my email address or don't know me, maybe reach out to someone who can connect you and introduce you to me. For example, Alok, you've introduced me to a few entrepreneurs yourself. That's one way of a second way of reaching out. The third way, LinkedIn has become a very, very effective place to connect and reach out to. A lot of entrepreneurs today reach out to us on LinkedIn. They directly message us and then we read them. And the fourth is, you can go to our website and always submit your plan or things like that. One of the philosophies that we have put in at Inventus is that we look at every plan, we read every email that comes in, and we ensure that we respond to everything within a reasonable period of time. Of course, I will be wrong if I say that I've been 100% true to that, but I can confidently say that 90-95% of the time I've been able to respond to and look at every plan or everything that has come through. And the reason why I'm not able to do 100% is sometimes the volume just becomes very, very large. So just to give you a sense of numbers, we receive roughly around anywhere between 1,500 to 2,000 plans a year, and we end up making 5 investments out of them. It's a large volume that we look at, but we try to look at everything. We look at, evaluate everything, and respond to everything. So yes, there is a large volume, multiple ways of reaching out to us, and be assured that you will get a response from us.
So you said 5 to 7 deals out of 1,500.
Correct.
Wow, guys, that's how difficult it is to raise capital, and it's not only with Rutvik. I think most of the VC firms and investors, that kind of data they have, and that's where the people project entrepreneurship as very glorious, but that's how the reality of life is.
Correct.
But one thing which I wanted to ask you, Rutvik, is that I've asked this to many investors. What is the vis-a-vis ratio of acceptance between reference and cold emails? So if I send you an email that saying I have seen the startup and you can look at it vis-a-vis cold email, I'm asking this because the probability of raising fund from you is anyway very low, considering the quantum of deals which you see. So what is the easier way for a startup to get noticed?
So I think everybody, I'll distinguish the answer. I think everybody gets noticed. I don't think that there's any, we internally don't distinguish between things which come through a referral versus things which come through a cold email. That is not the criteria, and we do not factor that into our decision-making process. But however, if we look at our past data, it will appear as if there are more, of every 10 deals that would have been done, 9 of them have been probably come through referrals and 1 of them has been a cold. And the reason for that is not because we give more weightage to referrals. It is because at the end of the day, a good founder is someone who's also a good salesperson.
Yeah.
If you're a good founder, uh, yes, you'll be building your product, you'll be executing your idea, but a large part of your job is also selling. And when I say selling, you're selling to a potential co-founder to come and join your company and join your vision. You're selling your vision to the first 5 employees that you're going to be hiring, because you don't have anything at that point in time. So you're selling your vision to them. You're selling your vision to yourself, that I should not take up a job at any high paying company and do this for the next 10-15 years of my life. And to build a successful startup also, you will constantly need to be selling your product and selling your vision to the rest of people. So you inherently are a good salesperson. And because you're inherently a good salesperson, you figure out ways to reach out to people, and you have this innate ability to constantly keep networking and building connections. And hence, it just appears as if, the founders that we've backed have come through referral networks, because those founders are in a sales mode, and those founders are able to build those networks and reach out those connections out there. So that is why it looks like referral is the best way to go through. But the real reason for them is that these founders are hustlers, and these founders are good salespeople, and hence, the proportion of referral, and that's a big factor in, our evaluating our founders. Founders should be able to sell his or her vision and his or her product whenever during the early stages. So that's why it appears like that.
Really, I think that's very nicely put. And an entrepreneur needs to be a great salesman, and that's the first behavior which an entrepreneur should have. And if he's not able to sell his product and idea to his near ones, to his network, it's very difficult for him to convince an investor who would actually put in money, put his skin in the business. That's it. What's the ticket size your fund invests typically?
So the first check that we write is anywhere in the 5 to 15 or 5 to 20 crore range. That is the initial check that we put in. But through the life of the company, we can sometimes, that's the first check. And as the company keeps growing and as the company keeps maturing and it raises subsequent rounds, we continue to participate. And, if we can put anywhere up to 30 to 35 crores through the life of the company to help the company grow.
And one thing which I wanted to ask is that today, suppose you have evaluated a company, and there may be out of 4 parameters, maybe 2 parameters are there where you feel that the company is not at that point. So do you actually keep an eye on that company and see where it is going, and maybe reevaluate it after down the line 3, 4, 6 months? And are there any examples of those deals wherein you maybe said no at the ideation stage, or maybe at early traction, and then when the company was about to raise Series A or pre-Series A, you said, hang on, this company looks interesting, and they have actually executed, and they have been actually doing some good traction. Are there any examples? Or if because why I'm asking this is that I work with a lot of startups, and so I was talking to a startup, and he said that Alok, the biggest mistake which I did was that I actually reached out, since I was known to most of the investors. I was building my startup. So I actually reached out to investors at a very early stage wherein the traction was not much. And now after 6, 8 months, 1 year, when I'm reaching out to the same investor, they have a preconceived note and they don't want to again look at it. So I just wanted to understand, because it's very difficult to change that perception. So are there any example in your case wherein you have reevaluated and actually funded?
So yes, we've done that. So the way I think there have been some investments which have been a little early for us, and we've kind of stayed in touch with the founder, and 6 months down the line or 1 year down the line, actually gone ahead and done the deal once the company's maturity or some traction was built and things like that. So the mistake sometimes the founders end up making is they actually don't do their homework fully when they reach out to investors. So for example, if somewhere to reach out to me at the seed stage, the likelihood of me rejecting them is fairly high because I'm a predominantly a pre-series A or a series A investor. But at the same
Mm,
time, I would like to stay in touch with good founders and good ideas which are at the seed stage. So what the founder ideally should do is,
mm,
build a network with investors like me who are at a pre-series or a series A stage, and not press for a full-fledged evaluation or a full-fledged deep dive on the company. Because what happens, the way most VC firms work is one of the partners will always take a lead in the company, evaluating the company. Then the company goes, once the evaluation looks positive, the company is presented to the entire partnership and an investment committee. And then the investment committee takes a final decision on whether to invest or not to invest. Now, if a company comes very early, which is slightly earlier than the stage at which I am, and I choose to make that dive deeper and actually present it to the investment committee, the likelihood of the investment committee rejecting is higher because that this is not the sweet spot, this is not the stage at which we invest. But once an investment committee has rejected something, those preconceived notions do get built up, those biases get built up, and it becomes very hard uh, to bring that company back 6 months later or 1 year later into the firm. However, what the founder should do is meet with the lead partner, uh, have coffee conversations with the lead partner, seek their advice, have generic discussions, and acknowledge the fact that, hey, I understand that you are a Series A fund. I'm just here to bounce ideas, exchange ideas, understand what you like at the Series A stage, and stay in touch. So in that case, both the founder and the partner have built a relationship, and they choose to stay in touch and are not necessarily diving into that formal evaluation of the company at the stage which is not appropriate. And so then 1 year down the line, whenever the company is ready, the lead partner is far more familiar with the company. They've had a chance to track the progress of the company for almost a 1 year time frame. And when it gets presented to the investment committee later, even that case becomes much, much stronger because you have a comfort that the lead partner has built with that founder over a 1 year period.
I think thanks for addressing that. That will really help a lot of founders because not only getting in touch with right investors, but also at the right time is so important. So timing is so important, not only for investors, for entrepreneurs, for everyone, for all of us. And many of the founders do commit that mistake wherein they would, out of excitement, because most of the founders are hustlers, they will say, okay, fine, I've got this traction now. Let me just uh, send them send make my send my inbox on fire and send the teaser to 100 investors.
Correct.
And that's where the mistake they make. Rutvik, also, and now I want to discuss about exits, and that's very interesting in the Indian startup ecosystem, wherein we always had this problem for the first 10 years that Indian startups ecosystem में exit नहीं होता है क्यों क्योंकि IPO बहुत difficult है startups का and secondary sale बहुत difficult है. So I think that has changed in last couple of years, 3 years. So wanted to know your views on that in terms of, because ultimately till the time larger exits will not happen,
Yes.
you will not see larger Ps and LPs and family offices actually putting in fund. So what's your view, and has there been any change in the exit scenario of Indian startup ecosystem?
Absolutely. There's a huge change in the last 10 years since I've been in the ecosystem. 10 years ago, everything that I heard was that, exits don't happen in India. India is a promising market. And it was literally, as they say in Hindi, Ram Bharose, ki, let's hope that we invest in these companies will become big. And by the time they become big, maybe the exit ecosystem will mature, maybe the exits will happen. One of the hypotheses at that time used to be that once Indian internet companies become big or get some scale, the global companies like Amazon, Google, Facebook, etc., will come and start acquiring companies in India as they want to build their presence and go deeper into India. That's what people used to think, but that's not what has happened. And in fact, global companies still don't acquire in India. But the Indian ecosystem, on the other hand, has matured. So in the last 5 years, we now have, I don't know what, I've lost count now, 25 or 30 odd unicorns which have scaled. So they have become acquisitive. So if I'm a company which is a unicorn and which is a large company, I have the ability to at least acquire companies which are in the $50-100 million range. So that exit ecosystem has come up. Large conglomerates in India, which traditionally never used to acquire, for example, Reliance is right now is very, very, very active in the startup ecosystem. They are acquiring companies, and I've heard Tata's groups and other groups have also started thinking and have started acquiring. So the large traditional Indian businesses have started acquiring. And third is, of course, now you have some companies in India like Flipkart, etc., which have actually exited and which have become really big, which have become acquisitive and which are acquiring. So, the cycle has kickstarted. The first 5-6 years, we didn't know who's going to kickstart the cycle. In the last 5 years, we now know that there is a set of unicorn companies, Indian conglomerates, and companies, startups, which have really scaled like Flipkart, etc., which have the ability to acquire and have kickstart the cycle. Are we at reached the stage where the number of exits and acquisitions have reached a number which can sustain the ecosystem? No. But has the cycle been kickstarted? The answer is yes. So if I fast forward another 5 years, I think we'll have a much more robust and a healthy ecosystem where both exits happen and as well as investments happen. See, one of the, if I were to go back to that number, which I say that we look at 1,500 plans and make only 5 investments out of that, that tells you a story. It tells you that India is a capital-starved nation. There is no shortage of entrepreneurs. There is no shortage of ambition. There is no shortage of willingness to jump into startups, but there's not enough capital to support them. And why is there not enough capital? Because we haven't seen enough exits. Capital will only come if investors believe that, hey, if I put money in, I will get it back within 7-8 years or 10 years after a good, handsome return out of that. And in the absence of exits, you really needed those early adopters who were true believers in this ecosystem and wanted to change this ecosystem and put this money in. But once exit starts, and which has now, the cycle has kickstarted, 5 years down the line, you will see a lot more capital coming in because this money gets recycled.
That's good to know. And also to add to, I think IPO will also add to lot of ecosystem building and confidence. And I think there are a couple of good examples of VC invested companies actually going for IPO in India. So I think that has also kickstarted. I think the government and the authorities need to do a lot in terms as far as the IPO is concerned, because they need to safeguard the interest of small retail investors, but also they need to see whether if I want to take a risk as an investor and I know that I'm putting my money into a risk capital and risk asset, then I should get that opportunity to invest in a startup through the stock exchange. So I think that once that also gets matured in a couple of years, you will see a lot of interesting. Because today it's very difficult for a family office or for an HNI to directly find a startup and invest and get into that network. Because whenever there is an acquisition which is happening or merger happening, you have a small group, and when these will be traded on stock exchange, I think life will become really different. Rutvik, so considering what has happened in last couple of years, considering the technology adoption, considering you said that there is no dearth of entrepreneurship in India, there is no dearth of idea, there is no dearth of problems which we have in India to be solved. So do you feel that, and do you think that tier 2, tier 3 cities will also have some tractions now in terms of startups coming in, ideas getting formulated? As an entrepreneur, I don't need to travel to Bangalore or Mumbai or to NCR or to Hyderabad to do a startup. Do you see that that's finally coming in India, and you have smaller cluster of entrepreneurship?
Absolutely. I think that will happen. It has started happening in small ways in the last maybe 2 years. But I think after this COVID pandemic, this is going to just accelerate. Today, anybody who had to aspire to do a startup used to probably, migrate to a city like Bangalore and start doing here, because investors existed in a city like Bangalore. And more importantly, it was easier to hire talent only if you're in Bangalore, because it had the critical mass of engineers available. And when I say Bangalore, I mean Bangalore or NCR or Bombay, whichever, any of the big cities other than. But if you look at what has happened in the last 9 months, is that at least, and I can see that data from our own portfolio companies, that most engineers and most, especially the young people, have all gone back to their hometowns. They're no longer sitting in Bangalore. They're all working remotely. The companies within our portfolio are also now hiring remotely, irrespective of geography. So, if anything that this pandemic has brought, any positive change that this pandemic that has brought out, is that it has truly made, made it global, or made the geography irrelevant. So you could be anywhere, because we as investors are now doing all our meetings on Zoom exactly like this and making investment decisions. Founders are hiring engineers and hiring people based on Zoom, and everybody's working remotely. As long as it's a tech company, I think this can be done. And so we will see a lot more, entrepreneurs coming out of smaller cities like Indore or wherever in India.
That's great to know, and if that happens, then India will truly transform into an entrepreneur country, because it's very difficult for large ecosystem and population size which we have to survive only on 3 or 4 major metros.
Correct.
Let's talk about how can we have a webinar and not talk about pandemic. So let's talk about pandemic and how has been your life in the last 8 months. What has changed? Have you evaluated deals? Have you closed some deals?
Yes.
What's your experience in this new normal?
Yeah. No, so we have, one of the view that we took was, so we thought very hard in April, May as to what should our investment strategy be? Should we make any changes? Should we not do any changes, etc.? And then eventually we came to the conclusion that no, we don't need to change anything. The investments that we make are always with a 6, 7, 8 year horizon in mind. So these are long-term investments. If anything, the pandemic hopefully is going to be a short-term impact. That does not change anything from a 7-year or 8-year perspective. The macro trends of India still look positive. India startups will grow, problems will be solved. So we should not change anything, or we should not stop anything. The only change I think we probably did was to ensure that there will be volatility for the next 1.5 years. So if you're making any investment, make sure that at least those companies can survive for 2 years and are able to absorb any shocks that that the system gets because of the pandemic and the economic impact that it has on the country. Apart from that, there's no reason to change any of the other strategy. Continue investing because the future is still bright. And if in a 7 years time frame things don't heal it themselves, then we have much more bigger problems than just investing in those startups. So that's the view we took, and hence we continue doing. And in fact, we've closed investments within this pandemic itself. With meetings taken purely on.
Yeah. That's great. I mean, I think the new normal is when I and you accept that we don't need to travel to do these kind of webinars and meet people. I still remember I used to travel to Mumbai just for one meeting and come back for a cup of coffee. I think those habits, I hope that those habits get changed permanently. One thing which I missed, Rutvik, is in terms of sectors. So are you a sector agnostic fund, or do you have preference? And answer that in the current light of pandemic, wherein there are a lot of more automations, and we talk about lean startup and in terms of less and less physical touch.
Correct. No, so we are a tech focused fund. So we will, but with a very, very broad definition of tech. So we will be agnostic in terms of the sectors in which the tech is applied. So, the investments can be health tech, fintech, insurance tech, consumer internet companies, mobile internet companies, whatever it may be. As long as these are software, internet or mobile driven businesses, that's the mandate of the firm. And that's what we'll continue to invest in, irrespective of the sector. However, what we look for is, we look for capital efficient business models. So we are a small fund. We are not a $1 billion fund. So we need to be able to ensure we get into businesses which can scale rapidly with a lower capital requirement. So we will not do companies which require $100 million just to prove their business model. But with a smaller capital, if they can grow and achieve scale, those are the kind of businesses that we like to do. But in terms of sectors, we are agnostic.
I think I'm done with my set of questions. Ravi Shekhar is asking one question. During the pandemic, we have seen a lot of tech and startups. How do you see this? Is this the same you have encountered? I think we just addressed partly, but if you want to add anything more on that.
Yeah, no, so I think the initial part of the pandemic, we saw a dip, April, May, June, July, there was a significant dip in terms of the number of startups. I mean, because everybody was still trying to figure out what this means for them. But last 2 months, I think we've seen the pace pick up again. So people have adopted and are getting back to what it used to be.
And I think that today the GDP number for the second quarter will come out, and the discussion point or the expectation is that we will be around -8, 8.5, 9. So it's kind of recovered from where we were in the first quarter. And I think third quarter, if you ask me, other than hospitality and travel and some of the luxury industry, I think most of the other industries would have recovered by third quarter. So I think, and so add on to that. So in the pandemic, I have spoken to a lot of investors. They said that my first preference is to see that my portfolio companies do not run out of capital.
Correct.
So if I have to do a follow-up, if I have to do a debt, if I have to do anything, I will ensure that these companies, this portfolio companies, actually survive and come out. And if even if they survive and if they are alive on 1st of April 2021, we will feel that we have done good for them. So has that been the main mindset in your fund also, that we need to have portfolio companies and focus more on the current assets rather than look more into the new ideas?
No, there is a balance. Sometimes some funds I've seen have swung either directions. It depends on at which stage you are in your fund life cycle. For us, we were early on we're currently investing out of the third fund, and we were early on in the portfolio construction phase. So we are probably only 30% constructed as far as the portfolio is concerned. So we had to maintain the balance, and we've taken the necessary steps and measures required so that the existing startups can weather the storm and they don't get shut down by this temporary shock. So that we took care of, but at the same time, you can't ignore the forward-looking aspect, and we continue to invest and we'll continue to do so.
So with this, I am done with my set of questions, and I think we have covered a very comprehensive topic and covered everything. So with this, I think I'm done. And if you want to add something quick as a closing comment, then I will summarize and we will take it forward.
No, nothing. As a closing comment, I just want to thank Alok. Thank you for giving me this opportunity. It was a pleasure talking to you. I think our catch up over a cup of tea or coffee was long pending, and I'm glad we did this. At least over Zoom, this has become a little bit easier to do this now. So thanks for that.
I have just one query. Just let me take that. Somnath is asking, do you invest in AI-based HR recruitment space? So what revenue fraction will need to be met? I think that's very specific, but I will request Rutvik to answer in terms of the overall business. So AI, what's your take on AI and ML and into HR?
So I think the view we've taken is that AI and machine learning is now a horizontal technology. So it is not that AI is a specific segment where we invest or we don't invest. Most tech companies, I think they will have to use AI and ML in some aspect or some form in their company, no matter what they're doing. So AI ML is given. It is like 7, 8 years ago, any software company or any internet company, they had to build a mobile presence because mobile was absolutely needed. You can't just be a web. Similarly, AI ML has become a horizontal piece of technology right now. So yes, in terms of your HR/recruitment space, yes, we absolutely do invest. In fact, we've We had invested in a company called Asan Jobs, which is currently was bought by OLX, which was in the HR recruitment space for the gray collar workforce. So yes, we do that and we'll continue to invest in them. In terms of specifically what revenue attraction, that depends on the business model. I would say the way we look at it is not a specific milestone, but more in terms of the size of market and whatever proof points that you have in terms of your traction. Does it indicate that it is a growing market and there is that you're growing on a month-on-month basis? That means more and more people are accepting and adopting whatever you've tried to build. I think that is more important than the exact revenue number or customer number and things like that.
Thanks, Rutvik, for answering that. And with this, I say thanks to everyone, and I also say thanks to DBS Bank for helping us because so many of you did not know, but we have a deep penetration in Singapore, and we work with DBS in the India-Singapore corridor. In fact, our team in Singapore, we have hired more people in Singapore. So thanks to DBS for being our exclusive banker in the India-Singapore corridor. And we will come back again with another talk, dialogue with a very interesting investor. I'm trying to do that because I'm looking caught up for the next 10-12 days, but I will try to do it as soon as possible. And thanks, Rutvik, again for joining in on a Friday morning. I know it's very tough to take out time. Friday has always been very tough. When I was working with EY, Friday would be the most toughest day in a week because everyone wants their work to be done by that week, and it becomes a little challenging. So thanks for joining in again, and let's be in touch, and a pleasure to talk to you.
Thanks, Dr. Kiran. Thanks for having me.
Thanks, everyone. Thanks. Bye.
Bye.